every cycle scan runs into the same puzzle, and it does not matter whose software you are using. When you scan a chart for hidden cycles, you almost never get back a single answer. Instead, you get back 15, 20, sometimes 25 of them, and each one arrives with its own length, its own strength, and its own timing. Somewhere inside that pile sits the one cycle that is actually steering the price right now, while the rest are noise, or echoes, or cycles that mattered last month and have gone quiet since. If you pick the right one, then you get a window showing you where the next big turn is most likely to land. If you pick the wrong one, then you get a pretty wave on your screen that has nothing to do with what happens next. So today I want to show you, in the simplest way I can, exactly how I pick the right one. Picture a police lineup with 20 people standing in a row, where one of them is guilty and the other 19 just happen to be standing there. Your cycle table looks exactly like that lineup, because it hands you 20 rows when only one of them is doing anything useful right now. For a long time, I tried to spot the guilty one by looking at a single clue. Perhaps the strongest cycle was always the real one, or perhaps the best behaved one was. I tested every version of that idea, and on an ordinary day, none of them worked, because no single clue reliably points at the right cycle. That felt like a dead end until I changed the question I was asking. Instead of asking which cycle is the best one today, I started asking something quite different, which was whether the market is stretched right now in a way that makes it likely to snap back. At those particular moments, something useful happens, because the cycles that are due to turn and are long enough to be trusted suddenly stand out from the crowd. The lineup was never really the problem, and I had simply been asking it at the wrong time. So the method comes down to 3 simple steps, and I ask them in order. The first asks whether the price is stretched. The second asks whether this is the kind of market that snaps back, and the third asks which cycle is lined up to lead the turn. Step 1 asks whether the price is stretched, and for that, I use a simple tool called RSI. You can think of it as a rubber band being pulled, because RSI tells you how far the price has been pulled away from normal. When RSI drops below 40, the price has been pulled down a long way, and so a low may be forming nearby. When RSI climbs above 60, the price has been pulled up a long way instead, and so a high may be forming. Most of the time, RSI simply sits in the middle, and that is an answer too, because it is telling you to do nothing yet. The whole method only wakes up once the price is properly stretched. Here is the part that trips almost everyone up, and so I want to slow right down for it. Think about a rubber band for a moment. When you pull it, it snaps straight back to where it started, because that is simply what a rubber band does. Now think about a ball rolling down a hill instead, because a ball behaves in completely the opposite way. When you give it a push, it does not come back to you at all, and it simply keeps going. At any given moment, a market is behaving like one of those two things. Sometimes it behaves like the rubber band, which means that price gets pulled a long way in one direction and then springs back toward where it came from, and that is what we call a mean reverting market. At other times, it behaves like the rolling ball, because price keeps heading in the same direction and never springs back, and that is what we call a trending market. You will also see a third state on the platform, called a random walk, and my rule simply waits whenever that one shows up. This distinction matters enormously, and here is exactly why. A stretched rubber band market is the moment when a turn becomes genuinely likely, whereas a stretched rolling ball market can simply carry on rolling and become more stretched still. Buying every stretched reading in a rolling market is therefore one of the oldest ways there is to lose money. And so before I trust step 1 at all, I need to know which of those two markets I am actually looking at. Step 2 answers that question for you, and it uses something called the market regime strip. At the top of every analysis, you will see 4 small tiles, and each one asks the same question, rubber band or rolling ball, except that each one looks over a different stretch of recent history. The first tile checks the last 50 candles, the next one checks the last 100, and the remaining 2 check 200 and 400. It is a little like asking about the weather, because you might ask what it has been like this week, this month, this season, and this year. The short tiles react quickly whenever something changes, whereas the long tiles describe the bigger and slower picture. Every tile shows a color, and that color is what you read. Blue means a rubber band market, which is mean reverting, and green means a rolling ball market, which is trending. My rule only needs the two fastest tiles, and so the 50 and the 100 must both be blue. If the longer two agree as well, then that is a bonus, but it is not required. Once steps 1 and 2 both agree, it is finally time to open the cycle table, and this is step 3, which takes less than a minute. The table is sorted so that the cycles fitting recent price best sit at the top, and I only look at the top 5 rows, because anything lower down has too little agreement with the market to be worth trusting. Inside those top 5, I look at one more column, which is called phase. On the buy side, I keep only the rows marked bottoming, because that means the cycle is near its own low right now and is pointed to turn upward. On the sell side, I keep the rows marked peaking instead. A cycle that is simply rising or falling in the middle of its swing tells you nothing about the turn forming today, and so it gets ignored, no matter how good its other numbers happen to look. That brings us to the final choice, because among the cycles that qualify, I always pick the longest one. The reason is worth understanding. You can think of a short cycle as a light and jumpy passenger, because it can shift its whole position between one look and the next, which means the turn it promises today might move somewhere else tomorrow. A long cycle is heavier and steadier, and it holds its position far better from one look to the next, so the window it gives you is a window you can actually plan around. If 2 cycles both qualify, then I take the longer of the 2 without hesitating. And if nothing in the top 5 is in the right phase, then there is no setup at all, and that is perfectly fine. A method that always gives you an answer is a method you cannot trust, and knowing when to say nothing is part of what makes the good calls worth taking. Let me show you all 3 steps together on a real chart. This is the Australian dollar against the US dollar on the 1-hour chart. For step 1, RSI sits at 36, and because that is below 40, the price is stretched downward. For step 2, the 50 tile and the 100 tile both read blue, which is mean reverting, and so this is a rubber band market right now. For step 3, the top 5 cycles by fit include 2 bottoming rows, one at 91 bars and one at 39 bars, and so I take the longer one, which is 91. That single cycle marked the low, and the rally that followed is exactly what the method was built to catch. Next comes the euro against the US dollar on the daily chart at the start of 2025. RSI was at 37, which means the price was stretched downward once again. Both of the fast tiles read blue as well, and so this market was mean reverting. This time, 2 cycles qualified in the top 5, one at 155 bars and one at 196, and so I take the longer one, which is 196. That cycle's projected low landed right on the major low that kicked off the 2025 rally. Now we come to the S&P 500 futures on the daily chart in March of this year. This time, every single tile agreed because all 4 of them were blue, which made this a strong rubber band market. RSI sat at 39, and so the price was properly stretched as well. 2 cycles qualified again, one at 78 bars and one at 122, and so I take the longer one, which is 122. That cycle called the low, and the market went on to make new highs. Here is one more example, and this one flips the method upside down, because the sell side is simply a mirror of everything you have seen so far. We are looking at Bitcoin on the 1-hour chart. This time RSI is above 60, which means the price is stretched upward instead of downward. The fast tiles still read blue and still mean reverting, and so this stretch is likely to snap back too, except that it will snap downward this time. In the top 5, 2 cycles are marked peaking, one at 138 bars and one at 212 bars, and so I take the longer one, which is 212. That cycle marked the top, right before a sharp decline. It is the same 3 steps and the same rule, simply read in the opposite direction. Before I trusted any of this, I wanted proof rather than just a good story, and so I tested the method against real history. I used 11 different markets and time frames, running from fast currency charts through to slow daily charts, and together they covered 276 of these stretched moments. Each time, I compared the chosen cycle against a fair coin flip version of itself, which keeps the same cycle but scrambles its timing. The real method found the next big turn roughly twice as often as the coin flip version did, and it won in every single market I tried. That does not mean it is always right. It means it is genuinely better than guessing, which is exactly what you want from a method like this. There is one small extra tip before we move on. Sometimes every tile turns blue, meaning a rubber band and mean reverting market, and yet Cyclic RSI never quite drops below 40 because it stalls somewhere near the middle instead. When that happens, I check a second reading called Cyclic RSI, and if that one shows the stretch clearly, then I treat it exactly the same as before and go looking for the longest turning cycle in the top 5. It is the same rule, and simply a second way to notice the stretch for the times when the first one stays quiet. It is worth looking at what all 4 of those charts have in common. In every one of them, the setup came first, because the price had to be stretched and the market had to be behaving like a rubber band. And only after both of those lined up did the table get consulted at all. In 3 of the 4, more than one cycle qualified, and the longer one was taken every single time. And in every case, the projection gave a window in time rather than an exact date, because the turn showed up somewhere inside that window, which is exactly how you should read every cycle projection this method produces. Let us put the whole method onto one simple card. The first check asks whether RSI is below 40 or above 60, and if it is not, then you wait. The second check asks whether the 50 and the 100 tiles are both blue and mean reverting, and if they are not, then you wait again. The third check takes you into the top 5 cycles, where you keep only the bottoming rows or the peaking rows if you are looking for a top. The fourth check is simply to pick the longest one that qualifies. And the fifth is the one people forget, because if nothing qualifies at all, then that is completely fine, and you simply skip it and wait for the next stretch. That is the entire method, and it comes down to 3 simple checks followed by one simple choice at the end. There is one thing I want to be completely honest with you about, because it matters. Nothing you have just seen is a signal to buy or to sell. What this method gives you is a window in time where a turn is more likely than usual. And so it is a tendency rather than a guarantee, because the market can always do something different. It is also not the moment to click buy all by itself, because it only tells you where to look closely. The actual entry still needs its own confirmation, and that is a video for another day. Whatever you choose to do with any of this is always your own decision, made with your own judgment and your own risk. This tool is here to help you see more clearly, and it will never make the decision for you. So that is how I pick the right cycle out of a table that is full of them. I do it not by guessing, and not by picking the biggest number, but by waiting for the right moment, and then letting 3 simple steps do the choosing for me. Would you like to know how I confirm the actual entry once that window has opened? That is the next video in the series. If you would like to try this on your own chart, then you can run a free cycle analysis and open the market regime strip at the top of the page, because it is the same strip you have seen on every chart today. So please like this video and subscribe to the channel so that you do not miss the next one. Thank you very much for watching, and I will see you there.